Hello students, welcome to Accounting Explained at AccountWise Academy. This is Lata Venkateshwaran. This is the part 2 video of Annuity. The topics which we covered in part 1 video are meaning of annuity, types of annuity and ordinary annuity for both future and present value. All these things we have covered in the part 1 video. In today's video, we will see about annuity due both for future and the present value. I will be sharing the link of the part 1 video in the description box. You can go through it. Annuity due. Annuity due is defined as the annuity where the payment is made at the beginning of each payment interval. Suppose you are going to pay rent. Okay. And if it falls due on the first of every month. You have occupied the house on 1st of March and if you are going to pay rent on the same day on the beginning of the month, then this is called as annuity due. Annuity due is a series of payments which possess the following characteristics. What are they? Amount of payment should be same. So here the amount of payment is how much? Suppose if the rent is rupees 10,000, then the amount of payment is 10,000 and it is same for throughout the period till you occupy the house. Interval between the payment should be same. What is the interval here? Interval is every month you are going to pay rent. Payment should be made at the beginning of each period. So see here you have made the payment on 1st of March. So 1st of March, 1st of every month. That is the beginning of each period. So if an annuity qualifies all these characteristics, 3 characteristics, then you can say that as annuity due. With the help of this timeline, we can understand how ordinary annuity and annuity due works. We saw previously that we paid a rent of rupees 10,000 and we occupied the house on 1st March. And suppose we are going to stay in the house for 5 months. N becomes 5. So here n becomes 5 in both the cases. What is n minus 1 is 4 here. 4. N minus 2 is 3. N minus 2 is 3. N minus 3 is 2. Here also n minus 3 is 2. Here n minus 4 is 1. N minus 4 both cases same. Okay. So if you are going to follow ordinary annuity, that is if you are going to pay rent at the end of every month. So first payment, second payment will be made in the second month, third payment third month, fourth payment in the fourth month and fifth payment in the fifth month. This is how ordinary annuity works. Let us see how annuity due works. We occupied the house on 1st March, right? So on the same day, that is on the 0 month first day itself, our first payment will be made. Second payment will be made. This is the second payment will be made on the first month, first date. Third payment will be made on the second month first date. Fourth payment will be made on the third month first date. Fifth payment will be made on the fourth month first date. And in the fifth month no payment will be made. This is how ordinary annuity and annuity due works. Examples of annuity due. Rentals. You pay your landlord at the beginning of the month for the upcoming month's stay. So what did you do? Previously you paid rupees 10,000 per month as rent in the beginning of the month. Okay. Next is lease payment. Similar to rent, you make a lump sum payment upfront for the lease term. Suppose if you don't want to pay rent. Okay. What will you do? The landlord will insist you to make some lease payment. For this 10,000, he may ask you to pay rupees 2 lakhs upfront instead of monthly rent. So what did we do here? We have to pay rupees 2 lakhs at the beginning itself. Okay. So this is one example of an annuity due. Next is insurance payment. Similar to that, you pay your insurance premium at the beginning of the coverage period to be insured for the following period. Okay. So insurance premium should also be paid upfront before the coverage period starts. The above payments are made to cover services provided in the period following the payment. What you do is, you first make the payment and then you get the services done. That is a simple concept of annuity due. Future value of an annuity due. The future value of an annuity due is the value of consolidated payments at a date in the future considering a fixed return or discount rate. Annuity's future value increases with the increase in the discount rate. Okay, see this example. The future value of an annuity is used to calculate premium for life insurance. Suppose you want to insure your life for rupees 20 lakhs and the prevailing discount rate in the market is 8% per annum, and you want to insure it for 15 years or till your demise. Okay, how much premium you have to pay now? That is what future value of an annuity due helps us to find out. Okay. Similarly, for calculation of provident fund in the case where the monthly contribution act as a periodic payment. So when you retire, you want rupees 40 lakhs and you have 25 years of service pending still to go. Okay. How much monthly contribution of PF you have to make today or monthly every month at a discount rate, prevailing discount rate, let us assume it's 5% per annum. Okay. At a prevailing discount rate of 5% per annum, how much PF monthly contribution you have to make? So future value of an annuity helps us to find it out. Formula for future value of an annuity due. FVDN is equal to R into 1 plus I the whole power n minus 1 divided by I the whole thing multiplied with 1 plus I. In simple words, we can say FVDN is equal to future value of an ordinary annuity into 1 plus I. So, if you know the formula, so till here it is a formula for future value of an ordinary annuity. So, if you have future value of an ordinary annuity with you, just multiply with 1 plus I, you will get future value of annuity due. Okay, where FVDN is the future value of annuity at the beginning of each period. Note it. Okay, R is equal to regular payment at the beginning of each payment interval. I is equal to interest rate per period. N is equal to number of period for which annuity will last. Let us solve a sum to find out how to calculate future value of an annuity due. John plans to deposit rupees 50,000 at the beginning of each year for the next 7 years to save enough money for his daughter's education. Please note that the ongoing rate of interest in the market is 5%. Calculate the future value of annuity due using the above information. Even if they have not mentioned this one, no, calculate future value of annuity due, we can easily find out from the sum itself, question itself, what we have to find out. See, it is R is regular payment, that is 50,000 per annum you are going to make for the next 7 years. And you are going to find out some future value. Okay, and you are making the payment in the beginning of the month. So you have to find out future value of annuity due, FVDN, and the interest rate they have given is I is equal to 5%. Discount rate, interest rate, prevailing market rate, whatever you can call it as. Okay, I is equal to 5%. Let us see how to solve the problem. Let us do the solution now. Okay, so we know FVDN is equal to R into 1 plus I the whole power n minus 1 divided by I the whole thing multiplied by 1 plus I. Okay, so if we know R is equal to 50,000, I is equal to 5%, and N is equal to 7 years. 7. So FVDN is equal to R is 50,000, take here. 1 plus I is 1 plus 0.05 to the whole power 7 minus 1 divided by I is 0.05 into 1 plus I is 1 plus 0.05. So next step we are going to find out 1 plus 1.05 to the whole power 7. 50,000 into 1.407100 minus 1 divided by 0.05 into 1.05. Okay. What is 1.407100 minus 1? It is 50,000 into 0.407100 into 1.05 divided by 0.05. Okay. So this one point we have to divide and see. When you divide 0.407100 divided by 0.05, it is 50,000 into 8.142 into 1.05. On simplification, we get rupees 4,27,455 as future value of annuity due. So, Mr. John will get rupees 4,27,455 at the end of 7 years if he is going to deposit 50,000 at the beginning of each year at a interest rate of 5%. We are going to solve the same problem using the future value of annuity due table. Okay, we know R is 50,000, I is equal to 5% and N is equal to 7. So we are going to look at the table at 5% for 7 years. This is the future value of annuity due table. See, FAD is equal to 1 plus I the whole power n minus 1 divided by I into 1 plus I. This is what we are going to see now from the table. Okay. So we know that rows are n and columns are I. We are going to look at 5% for 7 years. So let us see where it matches. This is 5% and this is 7 years and this is 5%. Okay. So it matches here. So the interest factor which we are going to take is 8.5491. From the PV table, we took the interest factor as 8.5491. So, to calculate the future value of annuity due, multiply 50,000 R with 8.5491. See, you get 4,27,455 as the future value of annuity due, which is same as we got using the formula also. Present value of an annuity due. The present value of an annuity due is the amount of money needed to receive future payments discounted to the present date. Okay, let's understand this with an example. If a retired couple receives monthly payments from their insurance company, the present value of the annuity is the amount they need to save to receive those same payments each month. Your parents, suppose after their retirement, they want to receive rupees 25,000 per month as monthly payment. Okay, for that, how much they have to invest today to get this money? And this investment should be made at the beginning of the month to qualify itself as an annuity due. Okay, and this has to be discounted at some rate of interest, prevailing market rate. Okay. So this is what present value of an annuity due is. The formula for present value of annuity due is PVDN is equal to R into 1 minus 1 by 1 plus I the whole power n divided by I, the whole thing multiplied by 1 plus I. So in simple words we can say as this is present value of an ordinary annuity into 1 plus I. That's all. If you know the present value of an ordinary annuity, use it and multiply with 1 plus I, you will get present value of an annuity due. Where PVN is equal to present value of annuity at the beginning of each period market. R is equal to regular payment at the beginning of each payment interval. I is equal to interest rate per period and n is the number of periods for which annuity will last. Let's see a question on present value of an annuity due. Mr. Anil Kumar deposits 10,000 at the beginning of each year for the period of 3 years and the discount rate of 5%. Calculate the present value of annuity due using the following information. So R is equal to 10,000, I is equal to 5% and N is equal to 3. Let's see the solution now. So the formula is PVDN is equal to R into 1 minus 1 divided by 1 plus I the whole power n divided by I the whole thing multiplied with 1 plus I. So R is 10,000, I is equal to 5% and N is equal to 3. Okay. So PVDN is equal to 10,000 into R is 10,000, right? 10,000 into 1 minus 1 divided by 1 plus I the whole power n. It is 1 plus 0.05 to the whole power 3 divided by I is 0.05 into I is 1 plus 0.05. So 1 divided by, first is 1 plus 0.05 to the whole power 3 is 10,000 into 1 minus 1 divided by 1.157625 divided by 0.05 into 1.05. We are going to find 1 divided by 1.57625. 10,000 into 1 minus 0.86383 divided by 0.05 into 1.05. Next step is find out 1 minus 0.86383. 10,000 into 0.13616 divided by 0.05 into 1.05. Next step is find this 0.13616 divided by 0.05. So 10,000 into 2.7232 into 1.05. Next multiply this 2.7232 into 1.05. 10,000 into 2.85936 is 28,594 rupees. Is the present value of annuity due. We are going to take the same question and see how to calculate the present value of annuity due using the present value of annuity due table. Okay, we know R is equal to 10,000, I is equal to 5% and N is equal to 3. So we are going to look at the present value of annuity due table at 5% for 3 years. We are seeing the present value of annuity due table. So see here PVAD is equal to 1 minus 1 divided by 1 plus R the whole power, 1 plus I the whole power n divided by I into 1 plus I. Okay. So this is the interest factor which we are going to find now. So we know rows are n and columns are I. Okay. So we are going to look at 5% for 3 years. So 3 years go straight. Let's see where it matches. It matches here. So we have to take the interest factor of 2.8594n and substitute in the sum. We found the interest factor as 2.85941. So we are going to substitute here PVDN is equal to regular payment into 2.85941 is 28,594. So same also we got using the formula, no? So this is the present value of annuity due. Whether you use the formula or the present value annuity due table, you get the same answer. Do like our video and share it with your friends if you find it helpful. Subscribe to our channel, which will encourage us to make more videos like this one. If you would like to inquire about the accountancy classes which I take or to get more worksheets for problems with solutions, contact us at account.wiseacademy@gmail.com. Thank you for watching.